The aggressive flattening of the U.S. yield curve continues. Now, since early October of 2021, the U.S. yield curve, as measured by 10-year minus 2-year, had collapsed to a low of 38 basis points before eking out a small gain recently. This has occurred with general rise in rates and 10-year yields hovering near the psychological level of 2%, which it has recently eclipsed, and the 2-year having moved from 0.1% a year ago to a current level around 1.57. Now, even more striking has been the 10-year versus 5-year, which has gone from 55 basis points in October to a low of 7 basis points. Now, macroeconomists and traders have historically viewed the shape of the U.S. curve as an important predictor of the coming economic environment. As investment money becomes more cautious, it tends to seek the relative safety of U.S. Treasury bonds instead of riskier assets. This tends to drive long-end rates lower and faster than corresponding short-end rates. When the curve inverts or longer rates go below short-end rates, this oftentimes signals a recession is probable. Now, this metric has been pretty successful, having predicted 5 out of 5 recessions since the early 80s. Now, we can probably point to several reasons as to why the curve is flattening now. Perhaps the market feels that the Fed is signaling too aggressive short-end rate hikes and it could move us closer to a recession. Or maybe it's the fear that current geopolitical events could force money to seek safety. Or maybe it's because the Fed is still manually lowering long-end rates through their QE program, which is still in place, even though it's set to sunset soon. Now, if a trader believes that the geopolitical concerns or general recession concerns could cause 10-year versus 5-year to invert, an example of expressing that opinion would be to buy the February micro Treasury 5-year yield futures contract, priced in simple yield terms, at a current level of 1.98, and sell the February micro Treasury 10-year yield futures contract at 2.06. Now, this represents selling the spread at 0.08. A target for this trade could be the year 2000 inversion low at negative 0.31, and a stop for this trade could be placed at 0.21 positive, just above recent highs. This trade could make $390 if your target is reached and risk $130 if you're stopped out at your level. Now, a stop for this spread requires a little more attention because 2 assets are being traded. Now, if a trader believes that the flattening is overdone and the curve could steepen back out, they could sell that same February micro Treasury 5-year yield futures contract at 1.97 and buy the micro 10-year yield futures contract at 2.06. This represents buying the spread at 0.09. A target for this trade could be near last November's high of 0.41, and a stop could be placed at negative 0.11. This trade could make $320 if your target is met and risk $200 if you're stopped out at your level.